Welcome to Econverse. We hear so much about India's economy, where it's headed, but how do we actually gauge our standing, globally speaking?
Well, one key measure is the sovereign credit rating. It's like a financial health report card for the nation.
Exactly. And there's been some important news on that front recently. Moody's, they've upgraded India's long-term rating to BBB. So for this deep dive, let's really get into what this upgrade means for you listening, for the wider Indian economy.
Absolutely. A sovereign credit rating, it's essentially an independent look at how creditworthy India is, how likely we are to pay back our debts.
Crucial for investors, right? Both here and overseas.
It influences the risk they perceive. And a better rating, well, it usually means we can borrow money more cheaply.
Lower interest rates, basically.
Precisely. And it's a big signal, helps attract that vital foreign direct investment, FDI.
Okay, so this BBB rating, what does that actually tell us? Break it down.
Sure. So, according to Morningstar DBRS, who made this specific upgrade, BBB suggests India is good at paying back debt, but not perfect.
Good, but not perfect. So, generally okay, but maybe some vulnerability if things get tough economically.
That's the idea. It puts us in a solid category. But, perspective helps. BBB is one step below BBB plus A, two below an A rating. So room to improve, definitely.
Okay.
They also upgraded India's short-term rating, moved it up to R2, high, from R2, middle.
And that means...
It signals a strong capacity to repay short-term debts. So for lenders looking at shorter timelines, it makes India look like a pretty safe bet right now.
Interesting. But the outlook changed too, from positive to stable.
Yes. Which suggests that they see the progress we've made, hence the upgrade, but perhaps they're not expecting another jump immediately, more like consolidating gains.
So let's get to the why. What were the reasons Morningstar DBRS gave for this upgrade? This is the really interesting part.
They highlighted a few key things: structural reforms, better fiscal management, and critically, a stronger banking system.
These aren't just buzzwords, are they? They point to real changes.
Exactly. It's about concrete improvements in how the economy is being managed. Things like policy changes, how the government handles its finances, the health of our banks.
So the core message is India is improving its fundamentals, making it less risky for lenders.
That's essentially it. And a big factor they mentioned was India's strong recovery after the pandemic.
Ah, yes. The growth figures have been quite striking.
Very much so. They pointed to an average GDP growth of 8.2% between FY22 and FY25. That's impressive.
And what's driving that?
Well, they credit ongoing reforms, that big push we're seeing in infrastructure development, roads, rail, ports, you name it. Plus, they noted improvements in government transparency, financial accounts, and better quality of spending. More bang for our buck, potentially.
And the banking system you mentioned, that was key.
Yes, vital. The report highlighted that bad loans in banks have dropped significantly, down to 2.5%, which they say is a 13-year low.
That's a huge improvement.
Yeah.
A stable banking sector is foundational.
Couldn't agree more. They also mentioned inflation seems under control within the RBI's target band, 2% to 6%, and our external sector looks stable too.
What about geopolitical risks? Did they mention the border situation?
They did acknowledge the ongoing tensions with Pakistan, but stated they don't expect it to significantly impact the credit rating or economic growth at this stage.
Okay. So looking forward, what are the growth expectations?
Well, there's a bit of variation. The IMF, the International Monetary Fund, projects India's GDP growth at 6.2% for 2025 and 6.3% for 2026.
And our own RBI.
The Reserve Bank of India is actually a bit more optimistic. They're forecasting 6.5% in 2025 and 6.7% in 2026.
Why the difference?
The RBI seems to put more weight on the strength of domestic demand within India, seeing that as a key driver pushing growth potentially higher.
Right, strong internal consumption and investment. So let's talk tangible benefits. What does this upgrade actually do for India, for us?
Okay, the most direct potential benefit is lower borrowing costs for the government in international markets.
Like getting a better interest rate on a national loan because our credit score improved?
Exactly like that. If lenders see India as less risky, they'll likely charge less interest when the government needs to raise funds abroad.
Which frees up money for other things.
Precisely. But it's broader than just government borrowing. A higher rating really boosts India's economic credibility overall.
Makes us look more attractive on the world stage.
Yes. And that's a powerful magnet for foreign direct investment, or FDI.
So international companies looking to invest, build factories, set up offices here. This makes India look like a safer, more promising destination.
That's the hope. Increased confidence often translates into more investment flowing in, which, creates jobs, boosts economic activity.
And the government is actively trying to encourage this, isn't it?
Oh, very much so. A report from White and Case LLP noted India's already received something like US $1 trillion in cumulative foreign investment since April 2000. And they highlight specific government plans to boost strategic FDI even further.
Like what kind of plans?
Well, the report mentions things like potentially allowing more flexible financing options, like mezzanine instruments. There's also talk of proposed rules for 100% FDI in the insurance sector. And the finance minister has proposed setting up a high-powered committee specifically to look at hurdles to the ease of doing business, to streamline things for investors.
Okay, so lots of potential positives from the upgrade and related policy pushes. But we need a balanced view. Are there still concerns? Other perspectives?
Absolutely. It's crucial to look at that. Fitch Ratings, another major agency, offers a more cautious take.
So even with this upgrade from Morningstar, DBRS, Moody's, Fitch isn't necessarily rushing to do the same.
It seems not yet. Fitch analysts point to India's high public debt as a major challenge. It's running above 80% of our GDP.
It does sound high.
It is compared to peers. And they also highlight the cost of servicing that debt, the interest payments. These eat up about 25% of government revenue. Compare that to an average of around 8% for other countries with a similar BBB rating. So it's a significant burden, limiting funds for other things like infrastructure or social spending.
So that debt level is like an anchor.
It can be seen that way, yes, holding back potentially higher ratings.
The government has a target to reduce this debt, right? Down to around 50% of GDP by, 2031?
That's the stated aim. But Fitch analysts caution that hitting this target could be tough, especially if economic growth slows down. It really highlights how linked growth and fiscal health are.
We should also bring in what N.K. Singh said. He chaired the 15th Finance Commission.
Right. He referenced a Moody's outlook, noting that even if India meets its near-term policy goals, our overall fiscal strength is likely to stay weaker than many other investment-grade countries.
Why is that?
Primarily because the improvement in the overall debt burden and the cost of servicing that debt isn't seen as substantial enough yet.
Mr. Singh also made a point about needing cooperation between the center and states, didn't he?
Yes, a very important point. He stressed that the general government debt includes state-level debt, too. So real fiscal consolidation, bringing that overall debt down, needs a partnership. Center and states working together.
That's a shared responsibility, then.
Definitely. Now, stepping back even further, there's a broader discussion about credit ratings themselves.
How so?
Well, a report from the DDRN, the Debt Relief for a Green and Inclusive Recovery Network, raises questions about potential biases. They suggest there might be a negative bias in sovereign ratings towards countries in the global south. The argument is that this can lead to unfairly high borrowing costs and maybe less access to lending for these nations.
That's a serious charge. Does it relate to how the agencies operate?
Partly. The DDRN report also critiques the issuer pays model, where the entity being rated, the country, in this case, pays the rating agency. Concerns about potential conflicts of interest there.
I see. And the rating process itself, is it purely objective?
It's complex. It involves quantitative data, sure, but also qualitative judgments, subjective assessments. And that subjectivity is where potential biases can creep in, consciously or unconsciously.
Are there other factors people point to?
Yes. Looking at online discussions, like on Reddit, for instance, people sometimes bring up the influence of the big US-based rating agencies.
The fact that they dominate the market.
And also the fact that the Indian rupee isn't a global reserve currency. Some argue these broader structural factors might play a role in shaping where India's rating sits, regardless of domestic reforms alone.
Okay, so bringing this all together, this upgrade to BBB by Morningstar DBRS under Moody's, it's clearly a positive signal for India.
Yes, definitely. It acknowledges the reforms, the economic progress, and it holds the potential for real benefits, lower borrowing costs, attracting more FDI.
Which means a growth in jobs.
Absolutely. But, as we've discussed, it's not the end of the story. Significant challenges remain. So, continued focus on reforms, on prudent fiscal management, and crucially, sustaining that strong economic growth that's all going to be essential for any further rating improvements. It requires ongoing effort from everyone, government, businesses, all stakeholders across India.
Which leaves us with a final thought for you, our listeners. As India strides forward, how do we strike that difficult balance? The balance between driving economic growth, funding essential social programs, and managing our finances responsibly to strengthen our credit rating and ensure long-term stability for everyone.
And woven into that, how will global economic shifts, geopolitical events, how will they impact India's path? These are complex, interconnected questions shaping our nation's future, something to keep thinking about.